So thank you very much for coming today. We are going to be doing Microeconomics Chapter 8. We're going to focus on short-run analysis. So the first thing I'd like to point out to you is this study term here that I bolded. This equation says marginal revenue equals marginal cost. And this is your magic equation that is going to get you through the rest of the term. Now, this equation is the point on a graph wherever this occurs, whatever quantity, production quantity that occurs at, that is the profit maximizing quantity for the business. At any other quantity, more or less, the firm will have lower profits or bigger loss, depending on the case may be. Now, you're going to see a version of this later in the lecture that's going to say price equals marginal cost, and that equation only will work in perfect competition. But marginal revenue equals marginal cost works 100% of the time, regardless of which industrial structure you're in. So that's the one I want you to remember. All right, so here we go. Today we're focusing on costs of production. Now, to do your costs, you need to know the quantity of inputs you need and how much those inputs cost. This is an echo back to Chapter 7. What 3 decisions do you make? How much are you going to produce? What's the price? These two, the decision information will determine your revenue, but then you can determine these, and knowing the techniques of production available and the price of the inputs, these will give you your costs. So your total costs for a business can be broken up into 2 parts, a fixed component and a variable component. Now, the fixed component, clues in the title here, is fixed. It doesn't matter how much you produce. If you produce 0, you pay the same amount as if you produce 100,000 or 1 million or 10 billion. Fixed costs are often things like lease contracts or maintenance contracts or these kind of things. They occur only in the short run, and they're usually tied to the fixed factor of fixed input. Now, variable costs depend on the level of production. So if you produce 0, your variable cost is 0. Variable costs are always increasing. So the more you produce, the higher your variable costs. The classic variable cost is labor. Classic variable cost is labor. So total cost is equal to fixed plus variable. Now, if you remember the story I mentioned earlier in the term about my friend and their web business. So to recap, my friend had a web design, consulting, and hosting business, and they wanted me, hey, Sean, can you look at our books? Are we pricing properly? We feel like we're working too hard, not getting enough. Can you help us figure out what's going on? So the first thing I did is I said, sure, send me your cost structures. And they sent me this QuickBooks, all the relevant data in QuickBooks. And I was looking at it, and some line items, whenever you use this in practice, guys, some line items are in both categories. For example, this web design hosting business, they had a contract with Amazon Web Services. Now, the contract in Amazon Web Services for 0 to a certain amount of usage was a certain contract amount for a certain length of time. Well, that first entry, because it includes you had to pay when you were at 0, that was a fixed cost. However, everything after that was a variable. So you ended up with this stair-step method. And for those of you who are doing the homework in Chapter 8, you're going to get some experience doing a little bit of this stair-step stuff that does tend to happen when you have variable cost structures. All right, so here is a firm. Notice here's quantity, here's your fixed cost. Notice the fixed cost is the same regardless of how much you produce. Again, clues in the title, fixed. Now, some companies call this overhead. But notice your average fixed cost, which is your fixed cost divided by quantity. 100 divided by 1, 100 divided by 2, here is 50, 100 divided by 3, here's 33. Notice it trends towards 0. So average fixed cost shrinks and becomes asymptotically closer to zero as your quantity approaches infinity, as you produce more and more and more. This is called spreading overhead. Let me give you a graph of what it looks like. It looks like this. So notice here, as this approaches, gets bigger and bigger, it'll get closer and closer towards zero. Some businesses, guys, are dominated by this process. For example, think about Microsoft for a minute. Large chunk of Microsoft's revenue comes from the Office suite. Microsoft Word, Microsoft Excel, these kind of things. Once you've written the code, once you've written the application, right? That cost is sunk, it's done. How much does it cost Microsoft to make the next unit of Microsoft Office? Well, they got to print a little card with a code on it, maybe some fancy packaging if you want to be really generous with it, let's say $5 to $10, probably less than that. It's not a variable cost at all. Microsoft's cost structure is driven by fixed costs. Same is true in education. If you take two universities with exactly the same mandates, so research mandates, discovery, et cetera, two universities with exactly the same mandates, how much does it cost a university to put another person in the chair next to you? Not a ton, not much, maybe a little fee for the email system and the interface systems, but usually not much. By contrast, professor salary is the same, fixed cost. Electricity in the classroom is the same. So if you have two schools with the same mandates, the school that has larger class sizes frequently can have lower tuition because their average costs are lower. Now, you got to be careful contrasting a big research university against a community college that can have lower class size and lower costs simply because they don't have the same mandate. So there are all kinds of businesses that have this kind of structure. Total variable costs vary with output. So how do we calculate total variable costs? So here we have a table, capital and labor, and here's some price points. At 1 unit of output, you do the math, you would pick unit production technology B at $20. 2 units of output, you would pick B again for $38, total cost, total variable. And for 3 units of output, you'd pick 53. But Professor Yoder, capital is variable in this example. Yes, we're going to assume land is the fixed input here. So be prepared on an exam, guys, to face a table like this, and you're going to have to do these calculations. Now, for those of you who are like totally nirvana zen in with your calculator, matrices are your friends here. It'll save you from making mistakes. So your first matrix is a 6 by 2. It's basically this data you punch in. Second matrix is a 2 by 1. It's these two, the $2 and $1 here. Then you multiply A by B, and you'll get a vector, just a bunch of rows with these numbers. It's a lot easier than typing these in one at a time. Far easier to make mistakes. So if you need help with your matrices, call me, talk to me, come to office hours, whatever you need to do. I will gladly whip out my TI and work with you on yours and show you how to do this. Total variable cost curves. You know this is a total variable cost curve by 2 factors. Number 1, it's always increasing. And number 2, it goes through 0. So there you go. At unit 1, cost was 20. Plot it there. Unit 2, 38. Unit 3, 53. There you go. Now, marginal cost is the increase in total cost that comes from producing the next unit. But if you think about total cost, remember, total cost is 2 components. a fixed and a variable. So if I increase my output by 1 unit, does total fixed cost change? No, this is the title, it's fixed. So marginal cost is the additional cost from producing the next unit from either total cost or total variable cost, because that's the only thing that's changing. So if you look at your variable cost, the first unit cost me 20. 20 minus 0 is 20. Second unit was 38. 38 minus 20 is 18. Third unit is 53. 53 minus 38 is 15. Sorry, 38 minus 20 is 18. Now, marginal cost curve in the short run is tied to the fixed input and to this idea of diminishing returns we introduced last time. Imagine an accounting firm, right? I've got 5 computers. I hire the first accountant to work, they have a computer. Second accountant, they have a computer. Third, fourth, fifth. Okay, good. Now, when I hire the 6th accountant, somebody's going to have to share their computer, right? Notice the fixed input, computers. 7th accountant, now it's going to, so each additional tax returns, each additional stuff that I need, that I'm billing for, as I hire my variable worker and the costs come up, that variable worker is not going to be as productive as they were early on, simply because they have to share with another employee. This is the idea as to why marginal costs increase ultimately in the short run. So here's marginal productivity goes up initially and then diminishing returns set in. Notice marginal costs are the mirror image of it. So the marginal cost has this Nike swoosh kind of shape to it. And yes, it is the derivative of total variable cost with respect to quantity or total cost with respect to quantity. Now, average variable cost is just your total variable cost divided by your quantity. Now, this is important. Average variable cost is going to be a critical thing when we get to Chapter 9. All right, it's an overwhelming table, I know. I'm going to walk you through it. Hang in there with me. If you see something like this on an exam, I'm going to pull a question from the review pack. Let me show you. For example, here's a question. If Sherry produces 0 earrings, her total fixed costs are. Okay. So whenever you face a table like this, it helps to just go ahead and fill in the table for a second. So let me help you do that. Here's the table. Now notice total costs are 100. But at a quantity of 0, we know variable cost is 0. So total cost is fixed plus variable, which means total fixed cost must be 100. Once we have this total fixed cost, we know that all of them are fixed. So we can just fill that in. And notice we have total fixed and we have quantity, which means we can fill in average fixed now by just taking 100 divided by 1, 100 divided by 2, 100 divided by 3, etc. Now let's go down to the first row. We're given marginal cost is 50. So 0 plus 50 is 50. 100 plus 50 is 150, or 50 here in total variable plus 100 total fixed is 150. 150 divided by 1 gives us an average total cost of 150. And average variable is 50 divided by 1. There you go. Now we have a new one. We have average total is 95, average fixed is 50. Well, average variable plus average fixed is equal to average total. So 95 minus 50 would be average variable. That's 45. 45 times 2 would be your total variable. So 45 times 2 is 90. And you can fill in the rest of the way from there. Notice here we have average variables. So we can add these together to get average total. We can take these averages, this average variable, multiply it by 3 to get total variable, and then work out our marginal. Here we have total cost again. So we know this is going to be 200. Once we know that, that's 600, and then we can work out the rest of the row. And here we have 270. So we have marginal is going to be 70. We know that's going to be 370 and just working out the averages. So that's how you work through these tables. Generally speaking, whenever marginal cost is below the average variable cost line, average variable cost is falling. Whenever marginal cost is above average variable cost, the average variable costs are increasing. Now this point here, where marginal cost crosses through average variable, that's the smallest average variable cost is ever going to be. That's the minimum point of average variable cost. And in Chapter 9, you're going to learn that that has a special name. It's called a shutdown point. Okay? We'll cover more on that in Chapter 9. But this average variable cost and average total cost kind of have U-shapes. And at the very bottom of that U-shape, marginal cost is going to cut through the lowest point of it. So even if there weren't any labels on these graphs, you could tell which one is a marginal cost because it cuts through the bottom of a U curve and it keeps going. That's a marginal cost. So the difference between the total cost curve and the total variable, remember variable goes through the origin at 0, is just the total fixed cost point. And at every point, the vertical distance is just going to be $100. Average total cost works much the same way. Average total cost will have a U-shape like average variable, cuts through the minimum. This point, minimum of average total cost, that's known as the break-even point. That's shutdown, that's break-even. So the distance in the averages is just your average fixed cost. Okay. This is a useful thing. I liked, back when I used to do this in class, I used to allow note cards. And this, I would say, some of these equations, if you were having trouble remembering, these could be useful to help you find ways to get around something. Now remember, we are in perfect competition. So every firm is relatively small to the industry. They're all making the same stuff. So in perfect competition, total revenue is really easy. It's price times quantity. Price is given to you from the market because you're so small as a business. So here's the industry demand curve. Here's the industry supply curve. The equilibrium price is $5. Now the business itself, in this case the corn business, sees a perfectly elastic horizontal demand curve at $5. Now this is very useful. Now why is it perfectly elastic? Because the firm is so small. In the global corn market, if I supply 1,000 bushels or 2,000 bushels, it's meaningless. I'm never going to change the price. I'm never going to increase supply enough to move the price even a penny. I'm just that small. Likewise, if I went out of business, it's not going to increase the price. I'm just that small. So this horizontal demand curve has really interesting components. This price from the demand curve, price is equal to the demand curve, is also equal to the average revenue. The average revenue you get for each sale is $5, is also equal to marginal revenue. So price equals demand equals marginal revenue also equals average revenue. Now guys, this only works in perfect competition. If you're in any other industrial structure, it's not gonna work. This only works in perfect competition. So the profit maximizing point in perfect competition is where price equals marginal cost. But that's only because price equals marginal revenue. Marginal revenue equals marginal cost will work for all firms, period. All right, I know this is a busy graph. Let me walk you through it. I'm going to help you. All right. Here's our demand. Here's our supply. Price is equal to $5. Firm sees a demand curve equals marginal revenue at $5. Whenever you see this graph, what you do, the step one in analyzing this graph, analyzation, I just made that up. Right, analyzing this graph is to find the point where marginal revenue equals marginal cost. So here's our marginal cost curve, and it crosses the blue line right there in this point, and that's at a quantity of 300. So 300 is our magic number, and we draw a vertical line there. All your analysis is in reference to the quantity of 300. Now, if this price from the industry ever changes, you got to go back and redo price, marginal revenue equals marginal cost, and find the new quantity. So we're going to be a business. The price from the firm is 15, right? Okay. So to make the first unit, it's going to cost me $10 to make, and I'm getting 15 for it. Am I going to make the first unit? Yes. But Dr. Yoder, you're losing money. True, I am losing money. But notice I'm losing less money than if I was shutting down and producing zero. Because it's better to lose $5 than to lose 10. Okay. That's unit one. Unit two, I get $15 for it. It costs me $5 to make. Do I produce it? Yes. Why? Because I'm making more money. Unit three, I get $15. It costs me $5 to make. Would I produce it? Yes. Profit's going up. Unit four, I get $15 for it. It costs me $10 to produce it. Would I do so? Yes. Profit's going up. Unit five, I get $15 for it. It costs me $20 to produce it. Would I do unit five? No. So unit four, somewhere between 4 and 5 is the profit maximizing. If you can't get half units, then you're going to be at 4 and not 5. That's how marginal analysis works. So for a firm, as the demand curve shifts in the industry and prices were to go up in the industry, the firm would see these different prices, right? And they'd equate marginal revenue to marginal cost, and that's the quantity. So if you notice, the supply curve for the industry is just the sum of all the different firms' marginal cost curves coming up. So the marginal cost, the supply curve really is a cost curve underneath it. Okay, guys. So we're done with today's lecture. I know it's short. I need you to focus on the review pack. Next time we're going to do chapters 9, and I might split off chapter 10. Please make sure you read chapters 8 and 9. Go through your homework and do the review questions. It's going to help you a lot in the future. I appreciate you. Please give me a call if you have questions, or stop by office hours if we're in normal section, or reach out to me if you have any issues. Thank you much.